Hey everyone, welcome back to the deep dive. We're going to be getting into something today that I think a lot of you have probably thought about, how to really invest in stocks the right way going forward, thinking about 2025 and beyond.
Hmm.
And I know,
It's a big topic.
yeah, it can seem like really intimidating, right?
Yeah, sure.
Like how to actually make your money work for you, not just, sit there, but really like build wealth steadily over time.
Right, right.
So you can kind of take control of your financial future, be a little bit more secure.
Exactly. Yeah. And I think the thing is, stock investing, it's kind of like, everybody hears about it.
Yeah,
Everybody wants to do it.
right.
But it can feel like you're kind of wandering around in a maze, right? Like, where
Yeah,
do I even begin?
yeah.
But the good news is that the core steps to getting started, they're really pretty straightforward. Whether you're, somebody who's coming in and you have a good chunk of money to invest, or you're just saying, okay, I can put away 25 bucks a week, whatever it is, these fundamental principles are the same. And that's what's going to set you on the right path.
So that's what we're going to deep dive into today. We're
Exactly.
going to go through the steps, like step by step, break it down, make it easy.
Yeah.
Talking about, setting those really clear financial targets, right?
Yeah.
Figuring out how much risk you're actually comfortable with and how to choose those investment accounts. Like,
Yeah.
where's the actual money going to go?
Yeah.
Which ones are right for you?
Hmm.
And of course, we'll talk about how to actually pick those stocks,
Yeah. The fun part.
The fun part, yeah. But, this is something where it's not a set it and forget it
Yeah.
kind of thing.
Absolutely not.
And we're also going to touch on why staying curious and continuing to learn is so important.
It's a lifelong journey.
Yeah.
So we're going to, with this deep dive, we want to like cut through all that confusing stuff that's out there, give you like really clear, actionable insights, right?
Yeah.
So that when you're done listening to this, you don't just feel informed, you actually feel empowered
Yeah.
to like take those first steps and really feel confident about it.
Okay, let's unpack this. Let's start with step one.
Right.
Setting those clear investment goals. Okay, now this might seem really obvious,
Right.
but it's absolutely crucial to get right.
It's the foundation.
Yeah, like why is it so important to really nail down those financial achievements, those targets?
What's fascinating about this is that those financial goals, they really become like your North Star, right? In this whole world of investing,
Mm-hmm.
because they give you direction for the decisions you make.
Okay.
And they help you stay grounded, especially when, the market, inevitably it's going to go up, it's going to go down, it's going to be turbulent times.
Yeah.
And if you don't have a clear destination in mind,
Yeah.
it's really easy to just kind of get caught up in all that noise
Oh, yeah.
and make decisions that are really based on like the short-term whims of the market,
Totally.
rather than your own, long-term vision, what you actually want to achieve.
So it's kind of like having that roadmap already figured out.
Exactly. Exactly.
So, okay, like thinking about goals,
Hmm.
what kind of financial goals, when we're thinking about, investing, what kind of things should we be considering? Because I know, like, when I first started thinking about this, I was only thinking about retirement, like way in the future, right?
Yeah.
Like, is it important to think about, maybe shorter term things as well, even if you're just getting started?
That's a great question. And honestly, it's really beneficial to think about both your short-term and your long-term financial objectives, right?
Okay.
Short-term goals, those could be things like, saving up for a down payment on a car,
Mm-hmm.
or, maybe you want to go on that dream vacation you've always wanted to take, right? Those are short-term things. And long-term, yeah, that's where we get into retirement planning, maybe funding, education expenses for your kids or grandkids down the line.
Okay.
But the key here is that the length of time that you have
Yeah.
to actually reach each of those goals, that's going to influence what kind of investment strategies
Okay.
might actually be a good fit for you.
So how do we actually go about setting these goals? Like, what are some actionable tips that we can take away from this?
I'm glad you asked, because there are a few really important things.
Okay.
First of all, be specific.
Yeah.
Okay.
Okay.
Instead of just having a general goal in your head, like save more money, which everybody wants to do,
Right. Yeah.
try to make it something concrete, like I want to save, $10,000 for a down payment on a house, and I want to do that within the next 3 years.
Okay.
Or I want to have $500,000 of my retirement savings by the time I hit age 60, whatever it is, right?
Yeah.
The more precise you are, the easier it's going to be to come up with an actual plan to get there.
Right.
The second thing is determine what we call your investment horizon, which is just a fancy way of saying how long do you actually have to reach that goal?
Okay. Yeah.
Because, if you have 30 years
Yeah.
until you retire, that's very different
Yeah.
than if you have, 5 years to save up for that down payment.
Right.
And as we said, a longer time frame usually means you can consider, at least initially, some investments that have a little bit higher growth potential
Okay.
because you have time to, ride out any bumps in the road.
Right.
So those are the first two things. Be specific and think about your time horizon.
Okay. What else should we keep in mind as we're setting up these goals?
It's also really important to take a look at your current finances, right?
Yeah.
Really evaluate where you're at right now. Be realistic about how much you can actually set aside towards these investment goals and take into account, your income, how much you're bringing in, your current savings,
Yeah.
and any other financial obligations you might have, like, do you have loans to pay off, things like that. Then I would suggest trying to rank those goals that you came up with
Okay.
based on how urgent they are and how important they are to you.
Right.
So, for example, saving up for that down payment, that might take priority over, saving up for a vacation.
Right. Yeah.
Because one is, you need a place to live.
Yeah.
The other one is something that's nice to have.
So prioritizing.
Yeah.
Okay, that makes sense.
That's key.
And any last tips on setting goals?
I think the most important thing to remember is that, financial planning, this isn't like a one-time thing.
Right.
It's not like you set it and forget it. It's an ongoing process.
Yeah.
And your goals, they should change as your life changes,
Right.
right? So whether you get a promotion
Yeah.
or you decide to start a family, or maybe your priorities just shift,
Yeah.
your goals should reflect that. So make it a habit to go back, review those goals, see if they still make sense, and adjust them as you need to.
Okay, so we've got our goals, kind of clearly laid out. We've thought about them.
Yeah.
Now comes a really practical question, like how much can we actually afford to invest,
Right.
without kind of feeling like we're stretching ourselves too thin?
This is where, responsible investing comes in, right?
Yeah.
Because figuring out how much you can actually invest, that takes a real honest look at your overall financial picture.
Okay.
And the goal here is to make sure that you're building this investment portfolio
Yeah,
in a way that's going to support your financial stability, not jeopardize it.
totally. So where do we even begin to kind of get this clear picture of what we can do?
So the first thing is to really review all your sources of income, right?
Yeah.
See what's coming in. And one really important thing to check is, does your employer
Yeah.
offer any kind of retirement savings plans, things like 401k? Because a lot of times they come with some nice tax advantages,
Yeah.
and they might even match some of your contributions. So that's essentially free money, right?
Totally.
So if you have access to that, definitely take advantage of it.
Take advantage of it.
But the next thing, and this is so crucial,
Yeah.
before you even think about putting money into the stock market, make sure you have what we call an emergency fund.
Okay.
And this should be, ideally, enough money to cover, at least 3 to 6 months
Okay.
of your essential living expenses. So think about things like your rent or your mortgage payments, your utilities, groceries, all that stuff.
Like really essential. Yeah.
Yeah, the must-haves.
Okay.
Because this is your safety net, right?
Yeah.
This is what's going to protect you.
Right.
If something unexpected happens, you lose your job,
Yeah.
you have a medical emergency, whatever it is.
Right.
This prevents you from having to sell your investments.
At a bad time.
Exactly, at maybe the worst possible time.
Right.
When the market's down and you don't want to sell.
Okay. That's a really important point.
Yeah, after you've got that safety net in place,
Mm-hmm.
then I would say the next thing is to really focus on paying down any high-interest debt
Okay.
that you might have, especially things like credit card balances.
No. Yeah.
Because the interest that's accumulating on those
Yeah.
can really eat into any returns that you might be getting
Totally.
from your investments.
Yeah.
So it's kind of like you're fighting an uphill battle.
It's
Yeah,
like you're losing before you even get started.
exactly.
Yeah.
Once you've got that under control, then it's time to sit down and create a budget.
Okay.
And this is going to give you a really clear understanding of where your money is going, how much is coming in, how much is going out. And that allows you to say, okay, realistically, how much can I actually set aside
Yeah.
to put into the stock market? And it could be, a one-time lump sum. It could be, $50 a week, whatever it is. But your budget should make sure that you're not, dipping into money that you need to live on.
Right.
And remember, it's totally okay to start small.
Yeah.
Consistency is actually more important
Okay.
than the amount that you invest, especially when you're first starting out.
So those are some great points. Are there any really crucial takeaways from all of this?
two really important things I want you to remember. The first one is only invest money that you can actually afford to lose.
Okay.
And I know that might sound kind of scary, but the reality is the stock market has risks.
Yeah.
We're aiming for growth, but there's always the chance that things can go down.
Right.
And the second thing is never put yourself in a position where you're financially vulnerable
Yeah.
just for the sake of investing.
Yeah.
That's where we get into, the difference between investing
Yeah.
and, irresponsible gambling, right?
Okay, so we've got a pretty good handle on our goals.
Yeah.
How much we can invest, we're being responsible about it.
Yeah.
But now, how do we actually figure out what kind of investor we are? Are we somebody who's going to be glued to their phone, checking the market every 5 minutes?
Right.
Or are we more of a set it and forget it kind of person?
That brings us to the idea of understanding your risk tolerance
Okay.
and also your preferred investing style,
Okay.
because they're both important. So risk tolerance, this is basically how comfortable are you
Yeah.
with the fact that the stock market's going to go up and down,
Yeah.
right? And how comfortable are you with the fact that those ups and downs could affect your financial goals
Okay.
and aligning your investment choices
Right.
with that comfort level? That's key to
Yeah.
making sure that this is a sustainable experience for you.
Mm.
And it's less stressful because it can be stressful.
Oh, for sure. So how do we even figure out what our risk tolerance is? Like, there's no one-size-fits-all answer, is there?
There's not. And you can find like quizzes online and stuff
Yeah.
that'll give you some general guidance.
Yeah.
But it really comes down to just being honest with yourself
Okay.
and thinking about how you would react emotionally if the market took a dip.
Right.
Let's say the market went down, 10, 20%. Would you be able to stay calm? See that as an opportunity to buy more?
Yeah.
Ride it out? Or would you be panicking?
Yeah.
Feeling like you need to sell everything?
Right.
Are you someone who's comfortable with the idea that, higher returns usually come with higher risk?
Mhm.
Or do you really prioritize stability and knowing that your money's safe, even if it means maybe a little bit slower growth?
Okay, so it's really about knowing how you would actually respond in those situations.
Exactly. It's about your psychological response
Yeah.
to that market volatility because it's going to happen.
Can happen.
And what else plays into our risk tolerance? Are there other factors that we should think about?
Yeah, absolutely. So your time horizon, how long you have until you need that money,
Right.
that plays a huge role,
Yeah.
right? If you're saving for retirement,
And you're, 25 years old.
yeah,
You have a lot more time to recover from any dips in the market.
right.
So you can generally take on more risk.
Okay.
But if you're, 5 years away from retirement
Yeah.
and you need that money soon, then you probably want to be a little bit more conservative
Yeah.
to make sure that you don't lose your savings right before you need them.
Okay, so the longer you have, the more risk you can take on, generally.
Generally, yeah. And also think about your overall financial picture.
Okay.
How much do you have in emergency savings?
Right.
Do you have any debt?
Mm-hmm.
How stable is your income?
Right.
If you have a really solid financial base,
Yeah.
you might feel more comfortable taking on a bit more risk because, you have that cushion to fall back on.
So that kind of goes hand in hand. Right.
Exactly.
So the more time you have, the stronger your financial position is, the more risk you can generally take on.
Exactly. Exactly.
But how do we actually align our investment choices with these different levels of risk tolerance? What does that look like?
So in general, investments that are considered lower risk, those include things like stocks that pay dividends
Okay.
from, solid, well-established companies and things like high-quality bonds.
Okay.
If you want something a little bit more in the middle, more moderate risk,
Yeah.
you might look at a mix of stocks from what we call mid-cap and large-cap companies, which is just, the size of the company.
Yeah.
And you might look at things like index funds and ETFs. These are, baskets of stocks that track the overall market.
Okay.
And then if you're someone who's really comfortable with risk and you have a long time horizon,
Yeah.
you might look at things like small cap stocks, which are companies that have, a lot of potential for growth,
Yeah.
but they can also be much more volatile. They can go up and down really quickly.
Oh, okay.
You might look at individual growth stocks, companies that are in, cutting edge industries.
Mm-hmm.
And you might even look at, investing in specific sectors of the economy, like technology or healthcare.
Right. But one thing to remember
Yeah.
is that your risk tolerance isn't set in stone, right?
It's not fixed.
Like as things change in your life, your goals change.
Absolutely.
Your risk tolerance might change too.
Yeah. And it can evolve. As you get more experience in the market,
Hmm?
maybe you become more comfortable with risk, or maybe you realize, you know what, I'm actually a lot more risk averse than I thought I was.
Right.
So it's something that you want to
Okay.
revisit from
That
time to time.
reassess it. Okay.
Exactly.
So we've got the risk tolerance down, but what about the investing style? You mentioned that earlier.
Right, that's the other piece of the puzzle.
Yeah.
Are you a hands-on person? Are you a hands-off person?
Right.
And understanding your style will help you figure out the right methods
Okay.
and tools for you. Because some people, they love the process
Yeah.
of like researching companies, digging into their financial statements, analyzing everything. And we want to make all the decisions about when to buy and sell.
Right.
Other people are like, you know what, just tell me where to put my money
Yeah.
and I don't want to think about it.
Right.
So let's talk about those options. What are those options? The two main paths are what we call DIY investing.
Okay.
Do it yourself, and then they're seeking professional guidance.
Okay.
Within DIY, you have two choices. You have active investing,
Okay.
where, like I said, you're the one making all the decisions.
Okay.
You're buying individual stocks, maybe other assets. You're deciding when to hold them, when to sell them.
Mm-hmm.
And then there's passive DIY investing,
Okay.
which is more about investing in these, broad market index funds, ETFs, mutual funds.
Okay.
In this case, you're still choosing which funds to invest in,
Okay.
but you're not picking the individual stocks.
Right.
Within those funds, the fund managers are doing that for you.
Right.
And then the other option is professional guidance. If you're someone who says, you know what, I'd rather have someone just, hold my hand through this whole process.
Yeah.
I want personalized advice. I want someone to help me make a plan.
Okay.
Then working with a qualified broker or a financial advisor, that can be really, really valuable.
Okay.
These professionals, they can sit down with you,
Yeah.
understand your goals, understand your risk tolerance,
Right.
help you come up with a strategy, pick investments that fit that strategy.
Okay.
And then they'll monitor your portfolio, make adjustments as needed. So it's a lot more hands-off for you.
So you're paying for the expertise.
Exactly.
Yeah. Okay. So we've got our goals. We
Mhm.
know how much we can invest. We figured out our risk tolerance.
Mhm.
We know what our style is. What's the next logical step in this whole process?
It's time to choose your investment account
Okay.
and the type of account that you pick.
Yeah.
That can have a big impact on your taxes,
Okay.
the investments that are available to you,
Mm-hmm.
and just your overall strategy.
Right.
So it's really worth taking some time to compare different brokerage firms,
Okay.
see which one's going to be the best fit.
Okay. So there's, different kinds of accounts.
Yeah, there's a bunch.
Can you give us kind of an overview of what the main ones are and
Yeah.
kind of what the key features are, especially with taxes?
Absolutely. So the most basic one is just your standard brokerage account.
Okay.
This is a taxable account, which means that you'll have to pay taxes on any profits that you make.
Yeah. Okay.
But the upside is you have a lot of flexibility.
Hmm.
You can invest in pretty much whatever you want,
Okay.
and you have easy access to your money if you need it.
Right.
Then there's what we call managed accounts.
Okay.
And these are also taxable, but in this case, you're basically hiring a professional advisor
Mm-hmm.
to manage the investments for you.
Right.
So they'll make the decisions about what to buy, what to sell, all that stuff. But of course, they'll charge a fee for that service.
Okay. So you're paying for that expertise.
Exactly. Then there's something called a DRIP
Yeah.
account,
Okay. What's that stand for?
dividend reinvestment plan.
Okay.
And basically what happens here is any dividends that you earn from your stocks
Mm-hmm.
get automatically reinvested
Okay.
to buy more shares of the same stock. So it's a great way to take advantage of this idea of compounding,
Yeah.
where your money is basically making more money.
Yeah. Yeah.
But keep in mind that those dividends are still taxable.
Okay. They are. Okay. So those are some taxable options.
Right.
What about accounts that, might have some tax advantages?
Yeah, and these are really important,
Okay.
especially if you're saving for retirement, because they can make a huge difference in the long run.
Okay.
So first, you have employer-sponsored plans,
Mm-hmm.
things like 401k, 403bs, and 457 plans.
Okay.
And these often offer, what we call pre-tax contributions,
Mm-hmm.
which means you're not paying taxes on that money until you withdraw it in retirement.
Right.
And the growth is also tax-deferred, so it grows tax-free until you retire.
Oh, okay.
Then there's traditional IRAs, which also offer potentially tax-deductible contributions
Yep.
and tax-deferred growth.
Okay.
Now, if you're looking for tax-free withdrawals in retirement,
Mm-hmm.
then you have things like Roth IRAs
Right.
and Roth 401ks.
Okay.
And these are funded with money that you've already paid taxes on.
Okay.
But when you withdraw it in retirement, you don't owe any taxes.
Oh, Okay, so it's like taxed now,
Tax now, no taxes later.
not later. Okay.
Then, if you're saving for education, there's 529 plans,
Okay.
which offer tax-free growth for, qualified education expenses.
Right.
And finally, there's HSAs, health savings accounts.
Okay.
And these are really unique
Yeah.
because they give you a triple tax advantage.
Yeah.
You get a tax deduction when you contribute.
Okay.
The money grows tax-free.
Okay.
And then you can withdraw it tax-free for eligible medical expenses.
Wow. Okay, so that's a lot of different options. How do we choose? Like, what's the right fit for us?
So the first thing is to think about what your goals are. If you're saving for retirement,
Mm-hmm.
those tax-advantaged accounts, they're usually the way to go. If it's shorter-term goals or you just want more flexibility,
Yeah.
a standard brokerage account might be a better fit.
Okay, makes sense.
And then really pay attention to the fees
Okay.
because they can eat into your returns. And a lot of brokers now, they offer commission-free trading
Mm-hmm.
for stocks. But there might be other fees like account maintenance fees,
Right.
inactivity fees if you don't trade very often,
Yeah.
or management fees if you have a managed account.
Okay, so it's not just about the commissions anymore.
Exactly. It's the whole picture.
Got it. So look at the fees.
Yeah, look at the features that they offer.
Okay.
Do they have automatic contributions, which is a great way to stay consistent?
Yeah.
Do they have research tools, good market analysis?
Yeah.
Is their platform easy to use?
Mhm.
Do they have good customer service?
Right.
Are they secure?
Yeah.
These are all things to
Okay, and then the last thing is, what type of brokerage are they?
Yeah, are they a full-service broker? Which means you get a lot of personalized advice.
Okay.
But they might have higher fees and account minimums.
Okay.
Are they a discount broker, lower fees, less hand-holding?
Okay.
Or are they a robo-advisor,
Right.
which is completely automated?
Okay.
You just answer some questions, they create a portfolio for you, and they manage it.
Okay, cool. So now we've chosen our account, how we actually get the money in there so we can start investing.
Opening the account is usually pretty easy. You can do it online.
Okay.
You just provide your personal information.
Hmm.
Once it's approved, then you need to fund it.
Okay.
And the most common way is just an electronic bank transfer.
Mm-hmm.
You link your bank account, transfer the money in.
Easy.
Some brokers let you deposit checks, or if you have an existing account at another firm,
Mm.
you can transfer the assets directly.
Okay.
Through a process called AC, it's a standard way to move investments between brokerages.
Okay, and what about if we want to, invest consistently, like not just a lump sum, but, over time?
That's where automatic contributions come in. This is a
Okay.
great way to take advantage of what we call dollar cost averaging,
Okay.
where you're basically investing a fixed amount
Okay.
at regular intervals,
Mm-hmm.
no matter what the market's doing. So you might say, okay, I'm going to put in $100 every 2 weeks,
Right.
and it just happens automatically.
Yeah.
And that helps to smooth out the average price that you pay for your investments.
Yo.
Because you're buying when the market's up, you're buying when it's down.
Yeah, makes sense.
Most brokers make this really easy to set up.
Okay.
Once your funds are in there and they're verified, you're ready to start picking stocks.
Okay. This is the part that probably feels the most intimidating
I know.
to a lot of beginners.
Yeah.
Like picking those stocks, like where do I even begin?
Oh, for beginners, I would say start with companies that have a good track record, right?
Okay.
They've been around for a while. They're stable.
Yeah.
They have good financials.
Mm-hmm.
And they're showing potential for, steady, sustainable growth.
Right.
It's
Right.
really easy.